morning, ladies and gentlemen. Thank you so much. It gives me great pleasure to see bright faces on an early Mumbai morning, spending your weekday with us. EconomicTimes.com reaches 35 million readers every month. That mighty is our reach. Our digital platform engagement across web, app, and even the app is 6 times more than the digital engagement of the 4 competing business newspaper websites put together. So that gives you the breadth and the scale. EconomicTimes.com was, in fact, the first website that the Times Group launched way back 20 years ago. 5 years ago, we took a concerted effort and launched etmarkets.com to focus exclusively on the markets and finance and securities and brokerage communities. And that's why I thought that this is the time to launch the first ever ET Markets Global Summit. So thank you so much for participating in the first ever global summit that etmarkets.com has organized and put together. Coming back to the nation and where we are headed as a country, with $2.5 trillion economy, gearing up for $5 trillion economy in the next 7 years, good times have begun rolling for India pretty soon. The fastest growing economies amongst the world, World Bank put out the number of 7.5% growth GDP rate by 2020, and they say we can go up to 8% if there are certain structural reforms put together. So the good times have begun. We also live in a very connected world, 400 plus smartphones, 450 to 500 million internet users. Jio has launched and drastically changed the entire data and digital landscape of this nation. Everyone's connected on the digital front. But what's happening on the global trade is actually a process of deconnection and disengagement. So while we all are connected and engaging in conversations, technology is entering landscape of markets. There is also on the trade front that the world and at the geopolitical front, we're disengaging. Trump wants trade tariff barriers. Brexit is a reality in Europe. Catalonia wanted to move out from Spain. So the world, in a way, is turning insular. The more we're connected, the more we want to be disconnected, it seems. We're sort of entering a protectionist era. So just when the entrepreneurs of India want to unleash and take over the world seems to be wanting to clamp down and protect their own turfs. And that poses a big challenge. With our economy, our companies want to go global. And the global counterparts want us to open up all the FDI routes, go through the automatic, bring in investments to India. But when we want to export, they want to impose trade tariffs. So that becomes a challenge for India and the Indian financial markets as well. How does India navigate the contours of such a protectionist mindset when it comes to the way the trade and the tariff and the geopolitical negotiations are moving on? And that is something that we will certainly deliberate on, because we do want to become the global financial hub for the world. And that's an aspiration we believe the time has come for. So while the world is falling apart has gone through its own set of reforms, right from demonetization, the bankruptcy laws, the bank frauds that we've gone through, consolidation in the telecom sector, GST reforms, a whole host of structural changes have happened in the Indian industry and the markets. Yet, India wants to move on. Its GDP is clocking. Its home market is still booming for us. So throughout the day today, we will deliberate upon many of these issues, right from figuring out how capital markets, whether they need regulation or should they be left on their own. Should there be a strict oversight and people controlling the markets, or should the bears and the bull be left on their own turf and chart their own history? Will cryptocurrency become the de facto currency in the years to come? or as RBI says, do not bother to engage, and will that trend continue? Is equity markets participation inclusive enough? There is 5,000 crore plus on a monthly basis money entering the markets through the mutual fund route, which has obviously put up valuations of some of the stocks way too high. Thank God there's been some correction, but everyone's worried because there's more money and more legitimate money, especially after demonetization, chasing the stock markets, what they're supposed to be. So all these issues throughout the day will deliberate one by one with an esteemed panel and speakers who know these topics threadbare. In a world of connected markets where digital seems to be supreme, there is also a shakeup in the financial world order. Is India really ready to challenge London and New York to become a global financial hub? Issues such as all of these will be discussed and deliberated upon threadbare. And mind you, this is just the start. At ET Markets and ET Online, we will take this agenda further. We will take the discourse further and take each point to its logical end and conclusion.
Well, thank you so much, ET Online, ET.com, for inviting me here. And I don't know whether this was a conscious decision or not, but I think I'm an economist by training, and economics, as you know, is a dismal science. And I was with the Reserve Bank of India, so I'm also an ex-regulator. Now, both dismal science and an ex-regulator can combine are certain to bring down the froth in the market. So I'm not sure whether this is whether it's a conscious decision when you invited me, that you wanted to kind of offset some of the, people who are going to be very positive and gung-ho about the market. But anyway, I'm not going to entirely spoil everybody's fun, but I think I hope to bring a touch of realism to what I think is a very frothy market. So with that, let me start. You have a wonderful panel over here, and what I plan to do is that, give each of these speakers 5 minutes each. I think Vidhu alone has a presentation. So let him go ahead and make his presentation, and after that we'll follow that up with 5 minutes talk by each of these people. And then we'll try and have question answers from the floor. What I plan to do is intersperse question answers with the floor with panel questions to our panelists. So with that, let me invite Vidhu to please make your presentation and tell us what is your view of the global economy, economics, politics, and how will it impact the Indian capital market in particular?
So, I opened the paper today and saw there was a headline called Rare Depression in the Arabian Seas. Then I thought I've chosen my title, correctly, because it's Winds of Change. So as you can see from this slide, our industry is actually has many moving parts. On one side, you have the people who are analyzing specific securities, looking at the economy as a whole, figuring out what is the impact it's going to have on specific sectors, industries, countries, and so on and so forth, and feeding in that information to asset managers by side who are going to take decisions based on the information and analysis that they are presenting to them. On the other side, we have the investment advisors and wealth managers whose clients principally are the people who have wealth to invest and who have needs to save, to borrow, and so on and so forth. And these are people who are trying to understand what are the risk tolerances. They write investment policy statements, they do asset allocation, and they change things based on what's going on in the lives of their customers, as well as in the various asset classes to which their wealth is being allocated. And in the middle, you have the asset managers who are responsible for taking care of these assets. They have fiduciary responsibility, and they manage these assets. And you can see that there are many different connections, and the ultimate investor outcomes that we see, both in terms of what's happening to the markets and what's happening to the lives of the people who are customers of these markets, depends upon things going right at every link in this chain. So if the people who are analyzing the markets, they don't do a good job, and the asset managers depend on that and they don't do a good job, then the outcomes are going to be bad. Similarly, if your wealth advisor is not doing a good job of listening to you and doesn't have the proper competence and understanding to do the right asset allocation for you, your outcomes are going to be different. And so it is very important for everybody to be competent and trained and understand and so on. And this is very good that ET markets and ET as a whole plays a big role in some of these things. So you are here today in many as a representative of one of these different parts of the industry. I'll just quickly skip over to the key part of my remarks here. All of you know that the industry faces a small number of different forces. We all know about the regulators. The regulators decide what's going to happen in a particular sector. For instance, the investment advisory regulations, SEBI trying to move the industry from a commissions-based, sales-driven industry to a fee-based, investment advice-driven industry. That's changing the structure of the industry. Similarly, technology, we talked about a lot of different changes that are happening in technology, and the global forces that those are driving changes in our industry. So we took all these things, and in the report that we did last year, we identified these 6 trends: demographics, how technology is changing the way individuals behave, how organizations, both large tech organizations as well as the banks and incumbent leaders in the financial system, they are using technology, including big data, machine learning, artificial intelligence, and so on and so forth. The economic imbalances, flows of capitals and savings and so on, which are happening across the world. The way governments are reacting, the way the views of the populations in countries like US and UK and Japan are shaping the way regulators behave, and the consequences for us in India. And finally, the way we are looking at our long-term resources. So we took all these things and we identified 4 scenarios. That is the scenario of fintech disruption, parallel worlds, lower interest rates, and purposeful capitalism. Now, I'm not going to dig into each of these things, but during the course of this discussion, I would like to respond to the conversation that is happening from these 4 lenses. So this is the proverbial elephant, you see, because it's very hard for us to understand what is going on in the world and what the impact is going to be on us if we start looking at individual events. But if we have a framework in front of us, and if we are able to see each of these large scenarios and how these are impacting us, then we are in a much better place to understand what the impact is going to be and how these changes are going to lead to changes within India. I will stop now, and we will pick up these points as, maybe we can just leave it up there and see how that gets integrated into our discussion. Thank you.
Morning, ladies and gentlemen. So if I was owner of a listed company in India, I would not be displeased with what's happened from 2014 to 2018, because honestly, without delivering significant returns, my market cap has gone up dramatically. I mean, and I'm not suggesting that just because my earnings haven't multiplied at the same pace as they did in the period from 2004 to 2014. 2004 to 2014, ladies and gentlemen, is perhaps a classic period where you could see a complete convergence between market positive attitude, growth in the market on one side, and corporate earnings on the other side. But if you look at 2014 through till 2018, we all know that the market's been largely driven by a significant re-rating in the multiple 15x to 23x at a point of time when corporate earnings through this period and until really the quarter ending December was largely single-digit corporate earning growth. So as I said, I would not be necessarily displeased as an owner of a listed company because my market cap has gone up dramatically, whereas my earnings have certainly not improved proportionately. We all know that the period from early 90s through till 2010, 2012 was driven by this whole concept, as Deepak spoke about, of globalization. People wanted to go out, focus on new markets, selling goods and services in new markets, investing in new markets was the fashion of the day. And to that extent, emerging markets like India benefited extremely from flow of lots of dollars, both by way of FDI as well as by way of FII investments into the country. In that sense, I think the period from 2014 to today is an interesting period to try and analyze. I think when Mr. Modi came to power, perhaps out of a planned foresight, perhaps by sheer accident, a few important things happened. First, the oil price, which of course resulted in significant gains from a fiscal consolidation and fiscal discipline perspective. Second, his attack on black money, sustained attack on black money. We can all sit here and debate about whether demonetization has had a positive effect or negative effect on growth, on GDP growth, on corporate earnings, and perhaps the jury, in hindsight at least, will agree that it's been more negative than positive. But the one big positive effect of demonetization, then followed by GST, then followed by RERA and everything else that Mr. Modi's government has done, is that he has moved the thrust of a large saving cycle from non-financial assets to financial assets. We all know we are a $2+ trillion economy. We save about 33%. We also know that only 1/3 of that was invested in financial markets because 2/3 of that went between real estate and gold. And the attack on black money has effectively meant that money which was invested in what we call unproductive assets has now all moved. That's perhaps also signifies and is supported by the flows that we see in mutual fund industry over the last certainly 2 to 3 years. So that sustained attack has actually changed the equation dramatically and perhaps at the right time. If you go back and see the inward-looking proposition of almost all global leaders at this point of time, whether it is Trump, whether it is Theresa May, whether it is Spain, whether it is Macron, almost certainly you see that people are now more interested in investing in their own country versus elsewhere. Had we remained in the original time zone where a lot of our Indian markets were dependent, where our Indian markets were significantly dependent on foreign and global flows, I think we would have had a serious challenge in terms of where the markets are today. By creating domestic liquidity at a point of time when leadership, global leadership was looking inwardly, I think Mr. Modi created a very, very, as I said, whether it was him, whether it was his leadership team, whether it was the finance ministry, they created a super buffer. And if you look at the allocation today, if you look at the investment pattern today, dominant part of the investment in the Indian market is from domestic institutions versus FIIs. And therefore, at a point of time when it is likely, and we see capital flows may go back because of increase in interest rates, because of increase in inflation in India, because of greater job creation in the United States, I think India in that sense is well positioned. It's also in one sense timely, ladies and gentlemen, because if you look at the last quarter earnings and then you see what we are predicting for this quarter and then going forward, I think GDP and corporate earnings are coming back. We moved to double digit for the first time in many quarters last year. We think we will repeat that performance in the quarter ending March. And it's our belief that the period from 18 onwards, 18, 19 onwards, will deliver superior corporate earnings, certainly double digit corporate earnings. Are there any challenges? Of course, there are two major challenges. One, of course, is oil. Benign oil prices have effectively meant that we've been able to manage our fiscal prudence quite rationally. Should the oil price threaten to move up, it's stabilized, but there was a point of time a month ago when it threatened to really break open. If that happens again, then obviously we'll have to start looking at fiscal prudence. We're already moving into a relatively higher inflation zone, and that itself will have challenges from a macro perspective. But overall, I would argue and say that any government that comes to power next year is probably blessed in similar ways to when the UPA came to power in 2004. the many changes, the many reforms that this government has brought in, and the ultimate effect of that, both in terms of, as I said, driving more liquidity towards financial markets, but even more important, creating a sustainable, what appears to now be a sustainable growth in GDP and an increase in corporate earnings. That regime, should, as I said, oil prices and inflation be appropriately contained, will mean that the new government coming to power, any government coming to power, will certainly benefit. We will go back to the 2004-14 period, where eventually, again, corporate earnings will have to grow for the markets to keep pace. And as I said earlier, the 2004 to 2014 trend has indicated, and that's not the first time, ladies and gentlemen. We can show you periods before that, where eventually corporate earnings and market growth tends to converge with each other. In terms of pure global events, challenges in the global economy, elements arising from the global economy and having an impact both on India generally and on the Indian economy and the Indian markets, I would like to believe that despite the fact that FII flows in India may slow down because of reasons that I mentioned earlier, FDI flows in India continue to be significant and sustainable. It's interesting that most strategic investors, including large financial sponsors, continue to believe in the India story. And so long as they continue to believe in the India story, flows in terms of long-term sustainable FDI flows will continue to be maintained. And that again augurs well from an Indian economy perspective. So whereas I do agree that at 23x, the market is seriously and more than fully priced, I would also like to believe that some correction in the market from one side, some growth in corporate earnings coming in from the other side, will eventually lead to a convergence of the two. And that, along with, as I said, liquidity coming in from the domestic segment, more and more domestic investors, more and more retail investors coming to the market, will mean that our markets continue to be driven to some extent by liquidity, but eventually by corporate earnings. Thank you very much, ladies and gentlemen.
Thank you very much, Ashok, for that very optimistic view, and I'm sure everybody in this room would like to believe him 100%, but to play the devil's advocate, I just point out that Ashok spoke about the disconnect between economics, the real economy and the markets. Likewise, I'd like to point out the slight disconnect, or rather major disconnect, between economics and politics. As anybody who's watched what happened yesterday in the by-elections in UP and Bihar, certainly politics does not quite believe that the economy is doing so wonderfully, and ultimately we are a democracy, and it's in a democracy, it is politics and it's a people's voice, neither markets nor economies that count. So with that, let me ask you, Prabhat, to please take over.
So we heard from Ashok. I think he's sort of done a pretty thorough job of it, but I can maybe bring some global perspective from FI's perspective and sort of run you through as what's happened as we see it. And forecasting is a very tough art. If you were sitting in India 5 years ago, I would have thought that India is going to go down. The markets were looking very choppy. India was considered one of the fragile 5 economies. And about 3 to 4 years later, India was one of the stable 5 economies in emerging market universe. So that's a number of 180-degree turns tend to happen. When we are getting to forecasting, there is never a sort of straight line that sort of comes through. But let's start with some numbers first. And I think if you really look at the participation of foreign investors in India, I think from last April to this March, about $2 billion roughly on net basis has come into Indian markets. And that's a really small number if you sort of consider 2 factors. One, that there have been a number of IPOs, huge amount of fundraise in India, and FIs have participated in some of the high-profile IPOs. Take that out, the secondary market inflows have been actually probably very small. And in fact, if you take out some of the other fund flows which have happened into dedicated India funds, let's say from a market like Japan, then I think from non-dedicated sources, the funds flows into India have been negative. And at least from a FI perspective. So actually, thank God for domestic flows, because if they were not there, we probably would have had a lot of difficulty, not only in terms of the level of the market, but also in terms of fundraisers which have happened for domestic companies over the last 1 year. And the whole funding would have essentially come to a standstill. So what has actually happened? I think the reason why this happened was because the starting point post the Modi government coming to power, or even before that, was a positive one. So India was a huge overweight around the time Modi government came to power. In fact, from September 2013 to April 2015, a total of $32 billion of FI money came into India. And post that, the total number is 7 billion. So we started with a massive overweight on India. And that personally, I think that numbers actually have whittled down quite a lot. So from that perspective, the starting point of a FI positioning in India, I think, has corrected quite a bit. So not as overweight as we used to be. I think there are some numbers which sort of indicate that we are either neutral to negative in terms of the benchmark. So, and why that has happened is because India was the only game in town when Modi government came to power. US was slow, Europe was slow, China was slow, commodity prices were low, so emerging markets which depend on commodities were imploding. All that has changed. So the emerging competing opportunities in the last 2 years, last 1.5 years, both in terms of developed markets as well as commodity-intensive emerging markets have essentially taken the lion's share of flow. And India has actually not seen that much inflow. But it's a good starting point, because if you're starting from an overweight position versus sort of neutral to underweight, and the economy recovers, then you probably have a probability that investors will come back, or at least will not see a further underweighting if the economy is recovering. I think Ashok talked a bit about fundamental factors. I should also mention a few concerns that global investors have at this point. 3-4 actually stand out, especially now when we talk to global investors. One essentially is about the banking sector. So while a lot of work has been done in terms of bankruptcy law, etc., but the concern essentially is that while growth picks up, the ability to finance it is being held back because of the fact that two step forwards, one step backwards in PSU banks, which hold the largest chunk of financing the corporate India as well as India, is hamstrung because of the lack of capital. The other concern which I've started hearing more recently is that investors are a bit wary of changes in tax laws. They want stable regimes. They don't mind paying taxes, but the fact is that they've sort of been a bit rattled by the fact that number of changes. We've sort of seen changes in the way you enter India, the long-term capital gains tax. So I think that is something that has been a bit disconcerting. And I think third thing obviously has been oil prices, which Ashok alluded to. I think it's probably largely been absorbed of the investor behavior. So unless something incrementally negative emerges, that should no longer. That should not sort of lead to a fresh sell down in India. Coming back to fundamental factors and sort of view on going forward, the fortunate part is the Indian economy, after a number of false starts, seems to be a more solid footing. The forecasts for India are that India will actually truly become one of the fastest growing economy. If you look at, for example, last calendar, India was not the fastest growing economy. China was growing faster, Philippines was growing faster, some other Asian economies were growing faster than India. But next 2 years, India will probably be the largest, fastest growing economy at about close to 7.5%. China is trending towards 6%. The other global economies are also growing slower. So from the perspective of the markets and the economy, hopefully that disconnect in terms of relative and absolute growth will be bridged somewhat. And I think, finally, just a bit about, global scenario. I think we talked about the protectionism that's coming through. Clearly, that's a cause of concern. Obviously, the other cause of concern is the fact that, for example, US is cutting taxes while India is raising taxes. The tax color might be different. We might be taxing long-term capital gains, but US is sort of cutting down corporate income taxes, but ultimately that either flows into earnings or returns. So India's competing tax position is sort of a bit worse than when what's happening globally, especially in developing markets. Liquidity tightening is another concern, but as long as liquidity tightening is in response to growth, typically markets don't tend to react very negatively. So if the global sort of protectionism reaches a point where it leads to higher inflation without growth benefits, then I think it will become a huge point of concern to the market. That's something we have to watch out for going forward. And obviously politics, because while politics might not, impinge on economics in the short term, but politics nonetheless has long-term connotations. We have seen time and again. So market will watch out for, especially at these level of multiples, what happens to state elections going forward, and as a precursor to what happens to central elections. But still overall, we do think that India is embarking on faster growth, both in absolute relative terms, should enhance the relative attractiveness compared to, let's say, China or other other emerging markets. There is a wall of worry in elections, banking situation, private capex, etc. But hopefully it will be climbed as growth continues to remain solid. And I would say that given the neutral to negative weight on India, I don't think FIs will be sitting back as much as they have been doing in the last 2-3 years. Simply because that overweight position has largely been sorted out. With that, I would hand it back to you.
Good morning, ladies and gentlemen. I am representing Metropolitan Stock Exchange, and other eminent speakers have talked about on various topics. I am focusing on basically the global trends and how it is going to impact the Indian markets. And basically, I have categorized some of my remarks into two categories, long-term trends and the short-term trends. In the long-term trends, while everybody talks about Chinese economy and how it is doing, and there are some concerns about that, there have been some studies which has compared what happened in the 20th century as US and Japan emerged as strong economies. Similar factors are, according to me, are going to play out in this century when China and India are going to emerge as very strong economies, and this could be the story which will play out in this 21st century. So, and the factors, according to the study, the factors are something like the way China and India have decided to use the energies, solar and wind power. So this is going to help these economies. Then the other factors like rapid urbanization and also the technological education. In the emergence of US and Japan in the 20th century was the engineering education and the manufacturing methods and technologies which were used. China and India are focusing on technological education, and this is going to help us a lot. This is a very broad remark which I'm making. Then there are some short-term trends which are currently playing out, which is everybody has talked about the imposition of tariff and trade wars. So it could have a very adverse effect on the markets globally also, and it could mean a lower return to the investors. There is a potential of rise in interest globally, and there are some indications of that. So it will also have its impact on the global markets, and Indian market will also be touched with that. As a part of stock exchange, it's my duty to talk something about that, what is going to play out globally as well as in India. What I feel that stock exchanges, the technology has assumed lots of importance, and it will continue to be like that. And new and disruptive technologies will emerge, which is going to impact this business. Fintech is going to be very important. So there are lots of things which are going to play out and make this whole market infrastructure space undergo lots of changes. One of that is people talk about distributed ledger technology, which probably is going to make some of the market infrastructure institutions like depositories and clearing houses irrelevant going forward. So there are lots of changes which are taking place, and some disruptive effects are also going to take place. We at Metropolitan Stock Exchange are very much conscious of these changes taking place. We are a young stock exchange. We are in our 10th year of operation. And what I feel that we are quite nimble-footed, and we can make lots of changes and adopt these changes which are taking place globally also. So watch out for that. We will come with some surprises in the market. Thank you.
Thank you to all my panelists for making it a very interesting discussion to start with. So, well, it would seem from all my panelists, and certainly if we look at what's been happening in the market past few months, Goldilocks has certainly come visiting. The question now is, can Goldilocks be persuaded to stay? Ashok, let me ask you. First question is, in India, Goldilocks keep coming and then dropping out, coming and dropping out. So can we have Goldilocks stay on in the Indian economy?
As I said, if you think about where the economy stands today, we are perhaps in the best situation over the last 4 years. As I said in my little presentation, brief presentation, aided significantly by oil prices, good monsoons, globally benign regime. Have we leveraged on all these positive factors in a manner that we can, to some extent, say that we are sitting here being able to predict the next 5 years as superior, earning growth and superior GDP growth? I think that's still to be tested. So despite my positive and optimistic attitude, I would say that a lot more has to happen. For example, let's go back to the fiscal prudence. We've compromised a bit of it this year. I still don't know whether the revenue projections on the back of which I believe we have predicted a relatively optimistic scenario of fiscal deficit next year can be achieved. We have several other factors that are giving us strong indications of inflationary tendencies. I'd like to believe that if government is not able to achieve its revenue target, and remember now with some of the other challenges that public sector banks have done, we don't even know whether the 210,000 crores that was originally, 210,000 crores that was originally budgeted, it was all to be funded from off balance sheet. So, it was obviously not taken into the budgetary exercise because it was all coming off balance sheet. But, those numbers are now going to be dramatically different. We have seen one new element take away 15,000, 20, 25,000, whatever the number is. We don't know how many more will happen. So I would like to believe that whereas there is reason to be positive and optimistic, and certainly cautiously optimistic about where the economy is headed and where the markets are headed, there are factors that can derail that growth plan quite easily.
Of course, that's always true of macroeconomics. There's always an if and a but. But if I can just throw this question open to the audience at large, how many of you really believe that India is in a sweet spot and it will remain in a sweet spot post-2019 also? One scenario up to 2019 and maybe beyond 2019. So hands up, how many believe that we're in this wonderful sweet spot which will continue? Oh well. You're clearly in a minority. Thank you very much for being on my side, the rest of you. But let me ask you.
You should ask people now, how many of you believe we won't be? And I'd like to see that answer.
Oh,
because that's a real answer. There you
That's true. A lot of people sitting on the fence. But certainly you can't have too many fence sitters. You have to vote one way or the other. Because come 2019, I know there is an alternative now that you say none of the above. But when it comes to this, I think you have to decide, is India in a sweet spot? Will it be sustained or will it not? Prabhat, in your presentation, you spoke about India being the fastest growing economy. And this is something that we take a great deal of pride in, especially when we talk about economy, markets. We say, oh, we've overtaken China. I frankly never understood what is the logic of saying we've overtaken China. China is a far richer economy than us. There may be reasons for that linked to the political system, but the fact is, just because we overtake China or just because we become the fastest growing economy is no great shakes. We also have the largest number of poor in any country living in our country, in the world, in our country. So how important is this a statistic? Is it that FIIs get more easily taken in by this fastest growing number economy, whereas we Indians, we see it warts and all, so we see much more closely? How important is it?
Well, so from market perspective, growth matters, first of all. I think that matters.
The distribution does not.
Well, so, I don't know what you mean by distribution.
Because I was just being a little provocative, but to say, growth is, to me, as an Indian, has no meaning unless it percolates down to the lowest strata.
Well, so to tell you the truth,
markets and investors look at growth, but ultimately, particularly in a democracy, unless that growth, tomorrow it could completely collapse. The country itself, future could be endangered. So are the markets being short-sighted when they look only at growth, or is distribution also something that they need to keep at the back of their mind, at the back?
Sure. So, I would argue that you cannot get prosperity even at the bottom of the pyramid without seeing growth. Because if you look at historically, and you can sort of look at the data, there's a very strong correlation of stronger growth with the movement of poor into upper echelons. So, and that's very, you can sort of see it in the economy. For example, when the growth picks up, it is everything starts growing faster, even the two-wheel demands start going faster. It's not happening because people are moving up the strata. Now, it could be that the richer are getting richer, and the relative contrast might be growing higher, but you cannot get, incomes increasing at the bottom of the pyramid if you don't have growth. So I think growth is absolutely essential. Now, you can redistribute that income through a fiscal process, which happens in India all the time because, the fact is that we're in large subsidies. So fruits of growth can be redistributed through a fiscal process by giving higher subsidies or, all that stuff. But without growth, you got nothing.
Or taxing capital gains.
Yeah, whatever. But you cannot
Touchy
get.
Subject enough
No, but you cannot get anything without growth because the revenues won't come. Government won't have, any handouts to give because there's no top line. So I think growth is absolutely essential. For markets, it matters because the markets trade on multiples. And, essentially what I'm buying is I'm buying earnings over a longer period of time. If I'm not growing fast, I'm not going to pay that much for those earnings. So I think growth from market perspective obviously matters. But I also think it matters economically, even from incomes. The process you follow, you can be interventionist, or without intervention, you can have a slower sort of, but everybody's incomes will grow when the growth comes. That's what I think.
Vidhu, India has benefited a great deal, I would say, not so much from globalization per se, but if you're looking at the markets themselves, what we benefited really is essentially liquidity. Monetary policy that the US Fed and many other central banks followed. And now with that coming to an end, along with voices being raised against globalization, particularly with Trump's latest salvo, how much support can the Indian economy and the markets in particular get from global forces?
So allow me to just complete I had a couple of thoughts about what you had asked before. We have a little bit of an unfinished agenda here in the whole Goldilocks conversation. The two things that we didn't talk about, one was banking system reform. I think we are not there yet. We are having the right conversations, and our long-term prospects will depend a lot on cleaning up the banks and getting the credit flow going again. I know that by some reckoning last year, the corporate bond market, issuances overtook the loans in the bank credit. I don't know whether that is good or bad because there could be a story behind that of reducing credit quality. And we talked about all those trust relationships within the market. And if you find that people have been sold products which are really, start failing on the fixed income side, then that could bring a wave of distrust of the markets that pulls the rug from beneath the feet of the, the enthusiasm that we see now and then feed into other things. And then if you don't have the FII flow support, suddenly you will find that, you see those cartoons where, you're running off the cliff and it's after you've gone a little while that you realize that now you're going to fall. So that possibility is there, and I don't know how, what you think about that. As far as global flows are concerned, we know very well this whole China One Belt One Road has been a big engine of pulling the world along with it. And if you remove that, then a lot of the wind goes off the sails. Things seem to be, I'm not an expert and it's very hard to say, things seem to be looking up, and we are not in the same despondent situation that we were in maybe a couple of years back.
Oh, certainly.
Right? But to what extent can the global, can we depend upon? I think Ashok seemed to say that we don't have to depend upon the global, the global growth and so on. But if we get our act together, there is so much that India can do, in the sense that we can compete better in the global markets, we can sell in the global markets, and we can reduce, we can get out of the situation where we were in, dependence on oil and this, that, and so on, not too much of an export. Competitiveness can improve over a period of time.
Uday, if I could just bring you in over here, because Ashok, as well as the other speakers, I think Prabhat also mentioned the fact that we're no longer so driven by FII flows. The fact that so many domestic investors, particularly through a mutual fund route, have come in through to stock market means there is a certain sustainability to the stock market momentum, which was not there maybe even 10 years ago. Every time FIIs lost face in India, the markets just really collapsed, with repercussions also for the currency markets. Now, this is a positive, most certainly. My question to you is, that many of the investors today through the mutual fund route also do not really quite understand what investment in the stock market entails, that it is a risky investment. Risk and reward go hand in hand. And like what we've seen in the insolvency and bankruptcy code, when home buyers are not getting their homes, government and the Supreme Court are intervening to say that, look, they should also be given preference vis-a-vis banks who are secure creditors. So my question, hypothetical question, is tomorrow, God forbid, in this audience particularly, the stock markets were to really tank and small investors were to lose big time. Would the government and SEBI be able to sit quiet? Will they be able to take the political flag? As we've seen, SEBI itself has cautioned investors, don't go entirely by the ad, mutual fund sahi hai, understand and invest. So is there that kind of possibility? Because ultimately it is a political economy. You cannot do what China does. The government has to be answerable to if people are feeling the pinch. Because we are talking about a society where there is virtually no social safety net. If a person loses all his lifetime savings in the stock market, if hopefully it will not happen, can governments, regulators sit quiet? Is it a plus or a minus?
Yeah, so I would say that though your talk was quite long, but I got the essence of your question, is that domestic flows and the trend which we have seen in a recent past, actually through mutual funds, lots of money is coming to equity market. That's what is fueling the rise in the indices. Whether it is a healthy trend or not, but regulators are worried that I have seen, okay, when markets were zooming and there is a correction, so now they are probably feeling little relieved. What I feel is that the markets will be, whenever there is a rise, there is a herd mentality and people want to take advantage of this kind of rise in the market. And since they feel that it is very risky, at least that realization is there on the investment public side, that don't go to the market directly, go through the mutual fund route. But that also is a risky idea. People are coming to realize that. So what I feel that sanity has to prevail in the market. And obviously regulators cannot keep quiet. And I have seen it from very close quarters that they are worried. Okay, and they want to do something. You must have heard about disparity between cash market and the FNO market. FNO market being speculative, the size is very big. So some steps are being planned to bring some sort of balance. So the regulator is talking about lots of things. So they cannot remain quiet.
So let me just ask the audience again, should regulators worry when stock markets run up? And the question is because what does running up mean? When do we say a market is overvalued? It's all a question of function of time. So how many really believe in this audience? Should regulators worry about the level of the markets or should they worry about volatility? Level. How many people feel Regulators should worry about the level. Only 2, that's all. So I think everybody else certainly is very happy. So I wonder what SEBI is doing over there because they are seriously concerned. Likewise, the US Federal Reserve, because we're talking about the global economy. One of the problems, one of the reasons why we are in the situation that we are in today is that the US Federal Reserve never worried about asset markets. They always looked at inflation as in consumer price inflation. So even when asset markets ran up, the US Fed did not act. Subsequently, it became too late because the US Federal Reserve believed it's easier to pick up the pieces. And as we've seen post-2008, it's not very easy to pick up the pieces. So with that, let me just throw the floor open to question and answers from the audience, answers from the audience, questions from the...
Maitli, just one point on the debate that happened. There were 3 or 4 different issues that got touched upon, very important issues. First, I think you asked a question to say, what if retail investor puts all his money and loses all his money? And I think all of us in different capacities are advisors to families, high net worth individuals from time to time. And the first point of caution that we share with everybody, I'm sure I do and I'm sure my colleagues on the panel do, is beware of mis-selling.
Don't put all eggs in one basket.
Beware of greed.
Okay.
It doesn't matter, where in this world, which part of your life and which part of your wealth, greed always has bad consequences. So don't beware of greed at all points of time. I would also say to you that I think one of my panel colleagues spoke about corporate bond market and why it has gone up. I would say to all my friends and people in the retail market that when you start looking at mutual funds, do start thinking and evaluating the underlying asset portfolio. It's very important, not just from an equity perspective, particularly if you are
But Ashok, we're talking about financial literacy in a country where even ordinary literacy is barely 60%. Yeah. And if you look at the studies of NASER, etc., they'll tell you that even 3rd standard, 4th standard children can't read ABC or Kakhaga.
Fortunately, Maitli, only 2% of our retail investors invest in the market.
Unfortunately or fortunately? I don't know whether it's unfortunately.
I would like to believe from a perspective of caution, I would like to believe that it's the 2% out of the 60%. And not the 2% out of the balance 40%.
Which is very clear from where the collections of mutual funds come from, because they come from very few centers.
That is true.
It's not as widespread as you would believe by looking at the numbers themselves.
But we're also talking about financial inclusion. So we do want this 2% to become larger.
But as we talk about it today, the one thing I would say is look at the underlying portfolio.
Absolutely.
Particularly of the debt funds.
Absolutely.
Do look at where that money is being invested. We saw 1 or 2 instances about a year ago where there were sharp surprises. And I dare say that if you look at it and do a proper diligence, you will get more surprises. And that is, in that context, we worry about the whole growth of the NBFC business. If you look at the multiples on which the NBFCs are trading, I remember I was interviewing a candidate in 2001 and I asked him, what's your degree? And he said, until yesterday it was BCom, today it's B.com. Very smart guy. We are in the same space now when it comes to NBFCs. Everybody wants to be in housing finance. Everybody's changed his name to lending business. It's wholesale lending, structured financing, SME lending, housing finance, consumer finance, two-wheeler finance.
Remember
so any questions?
This happened in
Do I see any hands up at all in the audience? Come on, guys, wake up. Yeah. Can somebody get a mic across there?
You're right, 96.
So it was nice hearing everyone. So the question that I have is the budget that we had last month. And the government is planning to double the farmers' income by 2020, what they have planned. And do you really think that is going to happen? Because there is a bigger population that drives the economy rather than people who are sitting in, big cities. So, do you really think that real growth coming in the future by increasing the consumption?
Maitli, you are most appropriate. You're the right person to answer this question.
Won over somebody to my side. Yes, I certainly think it's very important because in India, even though agriculture contributes a very small sector contribution to the GDP overall, the number of people, the percentage of population dependent on agriculture is huge. And as all of you are from Bombay would realize, it's very important to carry those people with us. So I don't think the government can possibly deliver on that promise of doubling, but we're all used to governments making promises and not delivering. That's a given. The question is, do we try? Does the government try? Because so I think it's important that the government keeps working at it, and I think the only way the government can really work at it, and this is a dangerous topic again to touch in a subject audience like this, is that if every Indian pays his taxes. Today the problem is that Indians do not pay taxes, and governments do not have sufficient revenue. They could invest in things like rural irrigation, rural roads, better seeds, better fertilizers, and that's very important. So I think it is important that the 2% that we talk about does not come just the 2% of the top echelons of society. It must percolate down. Until every Indian shares that dream, we just will not get anywhere. So I hope that answers your question.
Excuse me, ma'am.
Yeah.
Let's say government says that they try to double the income of farmers. Do you think it is good for India's future in long run? Do you remember when India was very, very good in 17th century?
You're going in an audience talking about the market and daily minute-by-minute movement. It's nice when somebody's talking about the 17th century. But anyway.
See, when you see the history, we were #1 compared to US. Our industry growth was very high.
Yeah, can you come to the question if you don't mind? Because I'm sure there must be others who want to.
So what will be effect if government just focus on the farming economy?
Okay, should we take a couple of other questions also?
Yeah.
Maybe some more on the market and the global economy?
Yeah, it is the core of India.
Absolutely, yeah. Some more? Any more questions? Yeah.
Yeah, hi, my name is Sambit. I just want to ask two questions.
Yeah.
One is your view on farm loan waiver. Now a lot of governments are saying that we'll give farm loan waivers. My question is, where will the money come from? First thing. And the second thing is that in terms of banking reform, we have regulators. We have got regulators for banking. We have regulators for the stock exchanges. Still, we have got frauds. So what is the role of a regulator, and how does a regulator act? Because worldwide fraud is happening every day. So what is your view, and how does a regulator can control this? Because we can have n number of regulators, but at the end, how do we control this?
Any more? Yeah, I see a hand over there. I think we take 5 questions, and then we can go to the panelists, and then we can.
Good morning. I have only a couple of questions.
Can you limit it to just one so that others get more?
Yeah. Okay. I will ask.
The most burning question. You have to have an answer to that.
Yeah. I will try to sandwich the both of them.
No, one.
Okay. Fine. I will keep it for later. My question is, one of the things which determines the Indian capital market's confidence is the banking system, because they both are symbiotic. It's a symbiotic relationship. As he rightly mentioned, the frauds are happening. But somewhere down the line, don't you, especially to Mr. Vidhu, my question comes to you, don't you think somewhere down the line, the basic thing of avoiding fraud is having a quality of credit itself improved? Is that where the regulators are missing the point to focus upon? That's my first,
okay.
That's my question.
Yeah.
Thank you.
Any more? Yeah, I see a gentleman there.
I had a quick question on if anybody in the speakers has a view on the economic survey of India, which has pointed out that agricultural incomes could actually go down by anywhere between 15 to 25%.
Okay, so we take one more question, and then maybe I'll throw it to give it back to the panelists. Yeah, I see a hand. I see a hand there. Oh,
yeah, good morning.
Okay.
This is Anurag.
Whoever gets a mic goes first. Yeah.
So, Prabhat sir pointed out that when India grows, will the banks be in a position, specifically public sector banks, to fund its growth? Now, with the concept of inward investing and growth of domestic companies, how do you see the finance coming through?
Okay. So I have
in terms of avenues.
Yeah, sure. So I have 5 questions. So I'll throw it back to the panelists, and then maybe, if time permitting, we'll take some more. So Vidhu, would you like to go first on the issue of fraud and ethics?
So we keep discussing. Are you a CFA candidate, by the way?
So his answer will depend on whether you say yes or no.
He's given level 2. Yeah, so I thought so. So, because we talk a lot about ethics, and professional standards and so on. And I mentioned briefly in my remarks that this whole industry rests on trust, right? And if I can't trust the person who is advising me, and that person cannot trust the person who is managing the money and so on, then we have a very hard time providing the outcomes. Now, fraud is one extreme. You can just have incompetence, or you could have pressures from your bosses or whatever it is. I have to earn my commission and so on. And fraud is an extreme in that spectrum. And I believe that while we are discussing all these things, we should also discuss what are the things that we can do as a community at the firm level, at the system level, and at the individual level to make sure that our whole system is becoming more trustworthy. So if you have this whole mutual fund sahi hai, and we are getting carried away with that, and everybody comes and tells you mutual fund sahi hai without telling you what the pitfalls could be, because they are able to get their commissions today, that is a problem. And of one type. And the problem of the other type is that, you were asking, somebody asked, where is the money going to come from for the farmer loan waivers, right? It's going to come from the same place where the money for corporate debt restructuring comes from you. Okay, so ultimately the effectiveness of the system as a whole depends on our ability to keep control of frauds and deliver on the promises that we are making to our customers.
Ashok, would you like to add to that?
It's very easy to sit back here and say, he did wrong and he did wrong and he did wrong. I would go back to the age-old question of what I did to prevent the wrong. We are all in some form or shape or other, many of us here on the panel are financial intermediaries. I think we carry a very, very important responsibility. And the responsibility we carry is to make sure that we give capital in the hands of people who will allocate it responsibly. It's a very important point that we as financial intermediaries miss all the time. A client comes to me and says, I want to do a QIP, I want to do an IPO, help me raise money from the bank. Very often, our client-centric approach and our duty towards our client pushes us to say, well, we must help him. After all, he's paying us our fees, he's a client. Whether it is your economics or it's the larger duty that you think you have in your capacity as a financial intermediary, you jump into that engagement immediately. How many of us actually do a thorough diligence in trying to determine whether there isn't enough track record and history in which this individual or this company has allocated capital and looked after the minority interest in a responsible manner? The moment we intermediaries, and again I said, this is not the only point, we often sit here and profess about why everybody else is wrong. I'm taking it back to us because we are the starting point of this exercise. If we as financial intermediaries do thorough exercise and ensure post our diligence that we are allocating, assisting people who allocate capital responsibly, a large part of the fraud will go away. Because those who commit fraud leave a track behind. Nobody starts committing fraud overnight.
So it's clearly a case of physician heal thyself. So
exactly,
what would you like to add?
Exactly.
Anything?
I think, the fact is that, if you look at globally, if you make it easy for people to get capital, they will get capital. And I think, while, it's a good idea to sort of all be, but, we have seen the whole global financial crisis happen because in very developed economies, greed went to the next level. So you could argue that these guys knew finance, they're developed markets, but the fraud still happened. So I think to some extent it also falls on regulators to put safeguards in place and make enough deterrents out. These people think twice. Sure. So I think the problem in India especially has been, I think that we never had a credit boom like we had in the last cycle. We have actually seen one in 97. Both times we have come to grief. In terms of absolute percentage of NPAs, we had 15% last time, we have 15% this time. The problem is that there's probably incompetence on one side, and there's greed on the other, and there's fraud. And either there's collusion or there's incompetence sort of coming against greed, and people are able to sort of take advantage. So I think our ability to sort of maybe put enough deterrents in place, bankruptcy law is a good example. For example, if you're going to take away companies from sponsors, they will think twice about before defaulting because, we have seen in the last cycle, a lot of promoters who defaulted came back and owned the same companies. And it was allowed in some sense. So I think my view is that capital markets by nature will engender some sort of greed. I mean, you can always move and strive towards greater responsibility, but in the meantime, it has to be a lot of deterrence from the regulators.
Greed per se is not bad. It's just when greed crosses borders and you give a go-by to basic ethics. In fact, no regulation can ever be completely foolproof. Yes. Just as you can never have a society which is completely without crime. Similarly, you can never have banks or capital markets without misdemeanors. They are part of human nature. So the answer really is to have prompt regulation, effective regulation, and severe deterrent punishment. I think unfortunately, and here I will hold the criminal judicial system in India the most guilty, because we just do not hand out punishments sufficiently strongly, sufficiently quickly, and the big always get away. So I don't think we really can say that you can ever have a fraud-free society or a fraud-free. And on the question of farmers' income, I think, the issue of whether we can double or whether we cannot double is immaterial. The question is, can we really continue to grow in a sustained way if inequalities continue to increase the way they are increasing? And I think the answer lies there, because all of us sitting inside this room, we're the privileged microscopic minority in this country, less than 0.001, etc. And we will not be able to continue to look at a bright future unless we think of those who are at the bottom of the pyramid. So I think when we talk about financial inclusion and we talk about things like that, farmers' income, I think it's very important to think that we are one country. And if we wish to stay one country, we have to take every single Indian along with that. So with that, let me just throw the floor open again, for we have 5 more minutes. So we can now take a quick 5 questions maybe, 1 minute each. Yeah. In fact, I have always just one quick, how many people in this room really think that you can really teach ethics, like Vidhu was saying, that they have a course in teaching ethics? Is ethics something that is taught to a child in the house when the child is small, or can you really teach adults ethics? How many people believe ethics can be taught, or is it something that comes with you from your childhood, from your homes, and you can either be, I mean, it's not something that can be taught. How many people believe that you can teach a 20-year-old ethics? You believe okay, that's good to know that you can teach. Okay, that there are some people who I sincerely believe that it's not possible if you reach the age of 20 without knowing what is right and wrong. I mean, there are certain gray areas like tax evasion, tax avoidance, where you could argue one way or the other. But there are certain things which are just not on. But it's good to know that there's always scope for you, Vidhu. So you mean you have ready clientele here. People
passing
believe
the exam, and we have a 200-page, book on ethics, which they are mugging up.
This is what Shakespeare said: the devil will quote the Bible for his purpose. Right. So okay, with that, questions come. Okay, sure. I think it's almost time for us to wrap up the session. So I'll just take these 3 questions. And Ashok, would you like to go ahead on what do you tier 2 cities and smaller rural areas, can we get them into the capital market? How do we go about it?
I think it's a slow process. We must get them. It's part of the whole financial literacy program that's run by several institutions. The regulator himself is making great effort in trying to include more and more people in the investment program. I think it's good for India, and I think it shall happen. It's a slow process, though.
Employment generation, you would like to add to that?
Yeah, I would like to add that, see, as a stock exchange, it is also our responsibility to go out to these tier 2, tier 3 cities and spread the investor awareness. Okay. So it is our role, and we are playing that role. But I completely agree with Mr. Wadhwa that it is a very slow process, and having financial literacy and investor awareness in smaller towns where liquidity is there, it's very difficult to achieve. But it has to be tried. It has to be done over a period of time.
Employment generation, Prabhat?
So I think employment generation, essentially I think you need essentially investment in the economy. Growing investment can only lift employment. You cannot lift employment just by, because you're going to produce, where agriculture you can't lift employment. So you essentially need to build more factories, maybe build more infrastructure, and essentially raise demand in the economy so that you need more people. You need to produce more steel plants, more people. So I think investments, and if you look at employment generation has typically been the highest when the investment cycle has been the highest, because you sort of need more people for more factories. This process was completely broken for the last 5 years because there was no private capex. Essentially it was falling, and therefore, if you're not putting a new power plant, you'll not employ more people. I think that the first stage of this essentially has been the push by the government in capex, but this is low-end jobs, construction jobs, etc. So I don't think there has been no employment generation, but it's not been the kind of jobs you want, and maybe not even adequate. So, but I think if the growth continues, then there'll be crowding in, essentially, of even private sector investors. So it's a natural process. I don't think you can sort of do it overnight. The government can sort of have a magic wand and it can create jobs just by waving it. On the first question, actually, I have another sort of point of view about financial inclusion. I think what is also changing in India is the cost of delivery, because the technology is making certain that you can actually reach even the smallest denominator by a very small cost, and the cost of, for example, this whole mobile phone revolution. You can do a lot more in terms of just reaching out to people through, and you talk to banks in India, they are going micro, which was not the case even 5 years ago. So I think financial inclusion will probably happen more rapidly compared to any other time in the past, because we are digitizing much more rapidly than we ever did in the last 5 years.
Well, in the interest of time, I'll just take the last question. The question that you asked about, so many bankers lending to the same customer, and how is it that people are not aware? The point is that, yes, we do have now an agency which collects all this information is required to inform. The Reserve Bank is the ultimate repository of all this information. But even if they were to make it public, I don't know how many of us in civil society really take the interest in finding out, because even when laws are debated in Parliament, and the Parliament refers to a standing committee, and the standing committee places ads in the paper saying, please, interested members of the public, please write into us and give us your views. I don't think, unfortunately, too many people give their views. That is the unfortunate part, that civil society, we really don't play our role. But with that, I think I've come to the end of my time. Let me thank my wonderful panel.
But don't ask people to give passports because they have 50 crores of borrowing. That's the other extreme.
Yeah, we always swing from one extreme to the other. That's given. So thank you very much to my wonderful panelists. And thank you also for the audience for being so patient and raising such interesting questions. Thank you very much once again.
Thank you.